In 1637, people sold their homes to buy tulips. In 1929, investors borrowed heavily to chase soaring stocks. In 1999, internet companies with no profits were valued in the billions. In 2008, millions became convinced that house prices could only keep rising. And in 2021, cryptocurrencies and meme stocks created a new generation of overnight investors. Different centuries, different assets, yet every bubble followed the same script. So why do intelligent people keep making the same investing mistakes? The answer isn't found in the markets themselves. It's found in human psychology. Every market bubble begins with something real. A revolutionary technology, a new industry, or a major economic shift captures people's imagination. Railroads transformed transportation. The internet changed communication. Today, artificial intelligence is transforming business. These innovations genuinely create value. The mistake isn't believing in the technology. It's believing prices can rise forever. Every bubble starts with a powerful idea, but as excitement builds, careful analysis slowly fades away. Investing turns into speculation, and expectations begin to outpace reality. In the beginning, very few people pay attention. Uncertainty is high, prices remain low, and most investors remain skeptical. This is when experienced investors quietly begin buying. They aren't following the crowd. They're looking for value before everyone else recognizes the opportunity. As Warren Buffett famously says, "Be fearful when others are greedy and greedy when others are fearful." They understand that the biggest opportunities rarely look obvious in the moment. Time and again, history has shown that the greatest fortunes are usually built long before the headlines appear and public excitement takes over. As prices continue rising, more people begin paying attention. Financial news highlights impressive returns, friends share success stories, and social media fills with tales of easy money. Skepticism slowly turns into curiosity, then confidence. More investors rush into the market, pushing prices even higher and attracting even more buyers who fear being left behind and missing the opportunity. At this stage, many stop asking whether an investment is actually worth its price. Instead, they begin asking a far more dangerous question: how much higher can it go? That's the moment psychology starts replacing logic. Then comes the emotion that fuels every bubble: fear of missing out. Watching others make easy money creates enormous psychological pressure. Friends boast about huge profits, coworkers recommend investments, and social media celebrates overnight success. Staying on the sidelines suddenly feels like a costly mistake. Investors who ignored the opportunity months earlier now rush to buy at much higher prices, convinced they still have time before prices climb even further. Ironically, this is often the most dangerous moment. Every market bubble grows because people fear missing profits far more than they fear losing money. Eventually, optimism turns into euphoria. Investors become convinced the old rules no longer apply. Valuations stop mattering because everyone believes prices will continue climbing forever. Phrases like, "this time is different," begin appearing everywhere. Experts predict unlimited growth, and anyone expressing caution is dismissed as outdated or overly pessimistic. Confidence reaches its highest point just as risk reaches its greatest level. Few people even consider what could go wrong anymore because optimism feels unstoppable. Ironically, the safest investments now feel boring, while the riskiest ones appear almost guaranteed to succeed. At the peak, almost everyone is bullish. Financial media celebrates record highs, new investors open trading accounts every day, and conversations about easy money become common everywhere. Taxi drivers, neighbors, coworkers, and even family members begin giving investment advice. The crowd becomes convinced that wealth has become effortless and that prices can only keep rising. Few people stop to ask whether prices still reflect reality or whether expectations have become too optimistic. History shows that when everyone shares the same opinion, the market is often much closer to a major turning point than anyone realizes. Every bubble begins to burst quietly. Prices stop rising as quickly, and small declines appear for the first time in months. Most investors aren't worried. They call it a healthy correction and confidently buy the dip, believing the rally will soon continue. Financial headlines remain optimistic, and many experts reassure investors that nothing has fundamentally changed. But beneath the surface, confidence is beginning to weaken, optimism is starting to fade, and the psychology driving the bubble quietly begins to shift. What once felt certain suddenly becomes just a little less convincing, even if few people notice it at first. As prices continue falling, emotions change rapidly. Investors who were celebrating profits just weeks earlier begin worrying about protecting their money. Selling accelerates, causing even larger declines. News headlines become increasingly negative, and uncertainty spreads across the market. The same crowd that rushed to buy during the rally now rushes to sell, desperate to limit further losses before prices fall even more. Fear replaces greed almost overnight. The psychology that pushed prices far above reality now drives them sharply in the opposite direction, often with the same emotional intensity. Eventually, fear turns into panic. Investors sell at almost any price simply to escape further losses. Many swear they'll never invest again, convinced the market will never recover. Yet this is often when experienced investors quietly return. While the crowd focuses on recent losses, they focus on long-term value and opportunities that fear has created. They understand that panic often drives prices well below what businesses are actually worth. The greatest opportunities rarely appear when everyone feels optimistic. They usually emerge when fear is at its highest, confidence has completely disappeared, and almost nobody wants to buy. Over time, markets begin recovering. The panic slowly fades, businesses continue growing, and confidence gradually returns. Ironically, very few investors notice this stage because fear still dominates the headlines. Those who sold near the bottom often wait too long to reinvest, missing the earliest and strongest part of the recovery. Many only regain confidence after prices have already risen significantly. History shows that the strongest opportunities usually appear when optimism is scarce and uncertainty still feels overwhelming. Every major market recovery begins long before the majority believes it's safe to invest again. Looking back, it's easy to blame tulips, internet stocks, houses, or cryptocurrencies. But the asset was never the real problem. The same psychological cycle has repeated across centuries with completely different investments. Greed, fear, overconfidence, and herd mentality fueled every bubble. Human emotions remained exactly the same while only the asset changed. Markets evolve, technologies advance, and new opportunities emerge, but investor psychology has remained remarkably consistent throughout history. That's why the lessons of every bubble remain just as relevant today as they were centuries ago. Most bubbles leave behind the same warning signs. Prices rise much faster than fundamentals. People borrow heavily to invest. Valuations are ignored, and easy profits attract inexperienced investors. Media coverage becomes overwhelmingly positive, while anyone expressing caution is criticized or dismissed. None of these signs guarantee an immediate crash, but together they suggest speculation is gradually replacing rational investing. The more of these warning signs appear at the same time, the more cautious investors should become. Learning to recognize these patterns early can help investors avoid some of history's most expensive and painful mistakes. Successful investing isn't about predicting the exact top or bottom of the market. It's about controlling your emotions when others cannot. Great investors remain disciplined during both booms and crashes. They focus on fundamentals instead of headlines and avoid making decisions driven by fear or excitement. They understand that patience and consistency often matter more than perfect timing, especially when emotions are running high and uncertainty dominates every headline and conversation. In the long run, emotional discipline often becomes a greater advantage than intelligence, experience, or even finding the perfect investment. So, why does every market bubble look so similar? Because markets are driven by people, and people haven't changed. Every generation believes its bubble is unique, yet the same emotions continue repeating throughout history. Technology will evolve, industries will change, and new opportunities will emerge. But greed, fear, and FOMO will always be part of investing because human nature remains remarkably consistent. The cycle may unfold in different markets, but the underlying psychology never really changes. Those who understand this cycle won't just recognize the next bubble, they'll be far better prepared to navigate it with discipline when it finally arrives.